Hey, good afternoon, everybody. Welcome aboard to ReadySetCrypto Trade School. My name is Doc Severson. Today is Friday, the 15th of November, and I have a lot to cover today. So today's trade school is going to have a lot of stuff going on. The market's been somewhat, sort of drifty right now. So we're covering a lot of options and derivatives topics lately, and that totally makes sense for this. So welcome aboard, whether or not you're joining me live. If you're joining me live, let me know. Check in and make sure that this is working okay. More than likely, you're probably going to be watching this on some type of replay. So, hello. And if you are watching on a replay, and if you have any questions on the material in this, please reach out to me, and I will certainly answer your question through email. So just support at ReadySetCrypto.com and just address Doc. So without further ado, let's get started with today's presentation. So I am going to go split screen down here in the left-hand corner, and let me know if that gets in the way of anything. Otherwise, we'll just, oh, hey, Anthony, hopefully this is all working. So we got somebody live here. Let me know if everything is okay on your end. Not going to be going over any live trades today, so we don't have to worry about any legal disclosure on things. Today's topics are going to be other crypto options strategies, and then we're going to be talking about using Deribit futures. Okay. So what other strategies can we create to fit what the market is giving us? So many of you have written in saying, hey, it's been tough to sell puts lately because we're just not getting much of a volatility spike. And that's absolutely true. In the Ready Set Crypto Options program, I focused on two strategies to put the odds in your favor when the conditions are right. We're looking for a good spike. Now, we could just sell these put options like crazy, right? We could do that. But again, one of the conditions for selling put options was you have to sell it at a level that you'd be a willing buyer if you were physically assigned that. So keep that in mind. So those were the short put and the covered call strategies. Now, the implied or forward volatility does not always match the actual or realized volatility. We know that, right? And this is what we're looking at here. So the implied is the forward volatility, but quite honestly, what we're getting is some of these spikes are very, very, very low right now. So we got some good ones back here. Actually, this one wasn't so bad. The recent bumps have been very, very light. So we're just not seeing that much fear in the market. So we've got to be looking around at other things that we can be doing. Thanks, Anthony. So remember that the implied volatility is what you care about. It creates that excessive time value in the options that can be sold and melts away quickly. So that's why the majority of the program was about selling options by putting them in your favor. You've got that melting ice cube as you get closer and closer to the fire. So we've only had brief spikes to sell options with recently, and then not really at levels that comfortably sell them against. So you can still rent out your Bitcoin or Ethereum with covered calls. Just because we haven't seen tons of opportunity on the short puts doesn't mean that short calls aren't working. So you can still do those. Be careful about the next rally though. So this is why we're getting to today's topic of what else can we do? What else can we do with options? Well, glad you asked. If you guys have experience at all with options, or if you've traded options in the equity market, or if you paid any attention to all the myriad advertisements that are out there, there are dozens of different strategies. I remember one program that in particular that I subscribed to briefly way back when was they had 42 of them, 42 strategies that you could play. And that sounds great as a retail trader, right? wow, if 2 is good, then 3 must be better. And man, 42 must be I'd be on the moon. And quite honestly, I was one of those guys that was trading all types of stuff when I first started. I had calendar spreads in play, and I had iron condors going on, bull call spreads, bull put spreads, you name it, diagonals, butterflies. I had all kinds of stuff going on. Wasn't making very much money, though. Wasn't doing all that well. Not till I cleared the deck and focused on one thing was I able to strike out on my own. So there's dozens of different strategies with options that you can play against thousands of optionable stocks, right? So with crypto options, we're limited to just a couple of instruments. Really, like with Deribit, we just have Bitcoin and Ethereum. And with LedgerX, as far as I know, we just have Bitcoin. So unless that changes anytime soon, there's not much to work with here. We just have a couple of instruments with relatively poor granularity. What I mean by poor granularity is that think of the strike prices that we have. And in Bitcoin, they're separated by 1,000 points. Ooh, it's not very good granularity. You're not able to kind of narrow in on the strike price that works best for the trade. We also have very rudimentary brokers and tools. The brokers are the exchange themselves. So really, we can't leverage any of the great tools that have been around in options for the past 40 years. So let's see if we can add a couple to our arsenal. Okay, so a couple of things to set the stage here. What are the 3 main options variables again? These are the main ones. There's other ones there, but when we talk about options, the things that change when we're turning into that puppeteer, we're changing price, time, and volatility. Specifically, implied volatility. Those are really the 3 main drivers in the Black-Scholes theorem of the option value. Now, when we flip over to price, forget about the option for a second, we have to deal with price of the chart. It's the underlying instrument. And we have range contraction, range expansion. Remember our fractals. So let's see what combination of these variables gives us the right strategies. Now, again, I came up with this today, and I want to walk through what we have here. So think about this for a minute. First of all, let's talk about the vertical axis. Let's talk about the y-axis here. Forward price movement expectation. On a continuum here of low to high. So down here we have low forward movement expectation. We're not expecting price to move at all. In a case like this, though, we're looking for price to move a lot, right? So if we're looking at the vertical axis here, this is a case where maybe we've got a chart that is already broken out and it's trending and it's consolidating into some little pennant or something like that. We have a huge amount of energy and we're looking for this thing to absolutely bust a move. That is the forward price movement expectation. We don't know if it's going to go higher or lower, but we are expecting it to go bigly. On the other hand, maybe we've just seen something. We've just seen a big rally into exhaustion and we're expecting it to do absolutely nothing for the next couple of weeks or so, right? We've gone from range expansion, we're expecting range contraction. Kind of the opposite way that most people think about this. Again, keep in mind that this is the forward price movement expectation. This is not what we're seeing right this very second. Let's get over to the horizontal axis. This is the current implied volatility. Implied volatility is either going to be low or it's going to be high. And this is what we're seeing in the option chain. This is what we're seeing in tools like skew.com. The current implied volatility is something that we can, on any given second, we can find out what the forward look is of those options. And if it's low, it's saying nothing's happening, everybody's complacent, we're not projecting any big time forward volatility. This is what the participants in the option chain are setting this. Believe it or not, all that herd behavior is baked into the implied volatility. It's almost like a one-size-fits-all indicator that projects forward movement of something. Isn't that amazing? And of course, something where it's very high, typically we have very high when the price goes down like this, scares everybody to death. We get a big spike in implied volatility because they say, whoa, it's starting to move. So therefore, it's probably going to keep on moving. And in most cases, that is true. Okay, so now I've defined the two axes here, vertical and horizontal. And let's get into the 2x2 matrix here. If we have high implied volatility, we want to be sellers. Doesn't really matter what we think about the forward price movement expectation. We want to be selling options. This is why we look for those big spikes to the downside to be able to sell puts. And if we have low implied volatility, if we're complacent, then we generally want to be looking to buy. We generally want to be looking to buy. Now, there wasn't much in the program that I built about buying options because we didn't show you the right way. So this is what we're doing now this is kind of what we're going to be talking about here to some degree. Okay, so now let's add a little bit of color to this slide. Let's add some strategies to this. So all I've done is under the buys, I've talked about different strategies. So let's kind of walk through this thing. So, and I kind of tortured myself around this today. If we have low implied volatility and if we don't think the price is going to be moving much at all, there's probably different strategies that we can put, but quite honestly, this is not a horrible time to be using puts and calls. If there was ever one time where you would want to be using puts and calls, if there's ever any case to use straight long, this is where you're buying them, puts and calls, it's going to be during very, very low implied volatility. So there's not a lot of fluff in that option. And it's going to be during essentially quiet and trending type of behavior. Now, I don't trade these, but if you're going to do them, this would be the time to do this. Okay, so now let's go through the continuum here where implied volatility spikes. That's where we want to be selling the puts and calls. So remember, forward price movement expectation is still fairly low. Maybe this is where we had, some type of a movement. Okay. And this is because we've already had the movement. This is where we're going to be selling puts and calls. We've already had that spike to the downside, or maybe we've already had that spike to the upside as well too. And somehow volatility is still high. Okay. Let's go back to low volatility and let's go up to here. Now, if we have, this is a condition that we've seen quite a bit lately. High forward price movement. So this is where we have something, just coiled up like crazy, a lot of energy. And we're saying, wow, this thing's going to move. It's going to move. It's going to move. It's going to move. This is back in September. This is where we were going crazy, banging on the table. This is where we could use debit spreads. This is where we can use straddles. And I'll show you both of these here today. And then finally, we'll get back to this. This is where we have high implied volatility and high forward price movement expectations. So we think we're sitting on a pretty big move. We think it's going to move pretty quickly. This is where we can use credit spreads. These are out of the money credit spreads. Okay, so keep this 2x2 matrix kind of in the back of your mind. We're going to start going through some examples for these, and I'll kind of walk you through how we would do this. So a quick warning before I go into this, there's a lot of nuances. So I've just sort of danced lightly through these topics here. There are a lot of nuances, and this is the frustrating thing about learning options, is that there's so many little sunken manhole covers that are out there. You're walking along and you're just merrily minding your own business, and all of a sudden, boop, you disappear because somebody forgot to put the lid on that manhole cover, and down you go. And this was the funny thing. I actually learned options before I learned futures, and I couldn't get over it. The futures are so simple. There's no hidden tricks to them, or very, very few, if at all. But with options, there's a ton of them. There's always some little trick that you have to know. So there's a lot of nuances here. There's a lot of things I'm sort of skipping over the top of that you learn in time. Otherwise, this would be an 8-hour session. So please adopt new strategies. Don't take what we go over here and start putting it into live capital tomorrow. Please don't do that, because I will give you guff if you do that. If you come to me and say, hey, what do I do to get out of this lousy losing money trade? I will say, did you earn the right to do this trade? Show me the number of sim trades that you did before you took this one live that showed that you knew what you were doing. And more often than not, people just can't wait. They can't wait to make money with something. And don't do it that way. Don't be like every other retail trader that just blindly stumbles in. They can't wait to start making money because they get so excited. The dopamine starts going off when they see these strategies and they're like, I got to do this right now. Or there's also the cowboy that says, I learn a lot better if I am using real capital with that. Okay, great. Right. I was there once. That was me. So keep in mind that as of today, you cannot enter these strategies in one order. I can do this on all my equity brokers. They've got these great interfaces. I can right click and say, create this spread and do this and that. And I can send one order off and I can fill up to 4 legs at once. They do all the hard work for me, but we can't do that with crypto yet. This is the pain and the penalty of being early into this space. So this is almost like you're back in 1976 trading options in the equities market again. It's almost that primitive. So what you're going to have to do is these trades are going to be a combination of either one long and one short option, maybe one put, one call, maybe one call short, maybe one call long, short and long puts. And so you're going to have to enter at least 2 legs with every single one of these. More than likely, what you're going to have to do is enter the long option first. The long option in most cases is the insurance option. Certainly for the sale, when we're selling an option, it's an insurance option, or it can be the main driver of the trade. As soon as you get the long option in, then you can flip around and put the short on and create the spread. So let's go through these new concepts, starting with a vertical credit spread. Vertical credit spread. What on earth is that? It's called a vertical spread because you're using 2 different options that are separated vertically on the same chain, the same series. So let me bring over... Let's do this I'm just going to drag over a window here and say if we're going to do like a call spread, this would be the same. We're going to be using the same series, the same option series, right? So I'm not going to do a calendar spread. I'm not going to do one here and then another one there. These are on the same series. And this is the vertical element of it. Maybe what I'm doing is I'm going to buy this one and sell this one. That's why they call this a vertical spread. Now you can make these credit spreads or debit spreads. We're going to start off with credit spreads to begin with. And then we'll get to debit spreads in a minute. And you'll see what the difference is and why you would use one over the other. They will both be the same type of option, both calls or both puts. You will receive a net credit. This is the cool thing about this from the trade, because the credit from the short option will be larger. Leon's getting larger than the debit from the long option. This creates a limited risk trade. Now, all these are probably words right now. So I'm throwing out all these words right now and you're like, what on earth is What are you talking about, man? Show me something. All right, I'll get to a graph in just a second here. The max loss is the spread width minus the credit received. It's a limited risk trade. You can't lose unlimited funds on the trade. Trade works best when entered during high implied volatility. So quite honestly, this is where we, again, the puts, when we see that big drop down to a support level, this is where setting up a trade like this into a big drop and a big spike in implied volatility, this is where it's going to help this. Anytime you see credit, pulling in a credit, you're selling an option. You want volatility to be high when you're entering that. So in the position builder, which you got copied on in the options course, and what you can do is you can just kind of go over there and just copy this out of there, make a duplicate copy, and then you can create your own and then save it into your own little Google area if you want. Okay, so this is what this looks like. Now don't get confused with this. Forget about all this stuff down here. None of this matters. All we're doing is we're focusing on just these two options right here. So this is going to be a put credit spread. Here was the current price when I did this. And really what we want to do is we want to focus on this graph here. Because what happens is when you graph it based on BTC, you have, what's the word, recursion, right? You have accelerating effects. If the price starts to go down, then it affects the trade. And here we're using the stable US dollar to evaluate the trade. So we have fewer variables, okay? So here's what we're doing. For a put credit spread, what we're doing here is we're going to sell the closer to the money option, which in this case is 8,000. It's closer to the money, and you'll see a bigger credit. So this is a sell. And then we're going to buy the one that's further out of the money, which is 7,500. It's deeper. It's way further down there. And this one, we're only selling this. We're only buying this one for 0.026. These are BTC figures. So we're going to sell this one for 0.042, and we're going to buy this one for 0.026. The credit comes when you sell this one minus buy this one. There's a net credit that you get to keep. Here's where the current price is. Here's the magic behind this type of trade. Here's the current price. So remember me telling you with options, when you sell an option, the price can go up and you win. This is your winnings here. This is your winnings. It's fixed. It doesn't go up. It doesn't go up the higher the price goes. This is something a little different for you. This is a fixed credit that you receive. Just like an insurance company, they don't make any more money off of you unless they sell you another policy, right? So when you mail the check in, that's as much money as they make that month. This is the same thing here. The price can go sideways, and that's kind of what we want to see when we do a put credit spread. Sideways or up. The price can even go somewhat lower. Price can even go somewhat lower, and this is where we start to run into trouble. We get below the break-even line, and at this point down here, if the price is, 5,000, 6,000, things like that, that's where we get into our maximum loss. Oh my, maximum loss. But look at this. $400. And this is if we're using one whole honest to God BTC. We're using one full Bitcoin for this trade. We're leveraging one contract with a full size of one BTC. And the difference is why it's only $400 is because, again, we're selling and we're buying an option at the same time. This is why people are using options to take trades on something like Amazon, which is what, $1,700, $1,800 per share, or Priceline, or Google, or even Apple, or any of these other huge tech stocks that just cost hundreds and hundreds of dollars, Who the hell can afford to buy the shares of stock anymore? I mean, to buy 100 shares of Amazon costs you 180 grand. Seriously, nobody's got that cash just laying around. So this is what's called a put credit spread. Once you build a trade, you have a credit in your account, and it happens to be this figure here, which we'll go into the numbers in just a second. It's somewhere like $130, $140. So this is an asymmetric risk trade. You're getting a higher probability in exchange for taking a little bit more risk. Depends on how you want to design these. You can set them up with taking a bigger credit, take less risk with a lower probability. Okay, so that's a put credit spread. Let's go over the numbers. We're receiving short put credit, 0.042 BTC, and then we're buying the insurance option, which costs us a little bit less than that, 0.026. And so what we're left with is 0.016 BTC credit, or at today's price, that's $138. The max risk of this is the spread width minus the credit, or $500 is the spread width because we had the two strikes. All right, let's go back here. One was 8,000, one was 7,500. So the spread width is $500 minus the credit, which is 138 or 362.042 BTC. Probability of success was 72.4%. And the way that we figured that out, I believe here, is that we look at the max risk, 362. 362 divided by what's our, this is our max, this is, I forget the actual, this is the actual risk here is 362 divided by the spread width, which is 500. And that's how you get this figure here, 72.4%. It's amazing. Everything in options is based on probabilities. So you receive the max potential profit as soon as you create the trade. It goes right into your account. Boom. It's there. And now it's your job to keep it. You want to keep that credit as much as you can. Your job is to risk manage or defend it, keep as much of that as you can. So typically you would close these prior to expiration for a set debit. So nobody, let me back up here to the risk graph. Nobody just leaves these to expire. So you can. I mean, if we get a rally that goes up to 11,000 or something like that, and you've got this credit spread down there, and it's set for I think these are set for the December timeframe, then maybe you could just let it go. And there's nothing that needs to be done. These options will both expire worthless, and that's exactly what you want to happen. And then you keep the credit that you receive. You don't have to pay any money to shut down the trade, and that's all it's necessary to do. But typically you would close these prior to expiration for a set debit. How much is that? It depends on what you want to do. So what's an application for credit spreads? These are typically placed out of the money. So a very common application is to place them one standard deviation out of the money. Very, very common. A put credit spread is bullish. Call credit spread is bearish. These are also known as a bull put spread or a bear call spread. It depends on who's teaching you or who you hear this from, but you'll either hear put credit spread, bull put spread, bear call spread, or call credit spread, also known as vertical spreads. But they have to be specific as to whether it's a credit or debit spread. The best application is during a volatility spike, which usually comes to the downside. This gives the edge to the put credit spread. It's a very versatile trade. You have to watch out for the call credit spread because they can get run over during strong rallies. These are somewhat problematic. The problem is if you're going to enter a call credit spread, typically you're doing something like this, right? And where I see so many people do them is where, the price starts to fade back down. You get a rally coming up, it starts to fade back down, and everybody says, oh, it's bearish now. It's bearish now, without really understanding that the larger time frame trend is still trucking to the upside. And so what they'll do is they'll set up a call credit spread right up here. That's your short strike. Here's the short. Here's the long. And then what happens is the market says, oh, pull back right through there. Okay. Maximum loss. Not so good. You don't want to do that. So the idea with these things is, with a bear call spread or call credit spread, is you want to be entering these things right up here, or as close to the top as you can at some type of resistance level, certainly at exhaustion, and maybe even at more than one time frame. Like in the equities market, with the market that we've had the last 10 years, I won't put on a call credit spread unless I have weekly and daily charts in exhaustion, because I've got to have a pullback. And then what I'll do is that on the pullback, that's where I'm taking the trade off. I don't want to sit through this again. I don't want to go all the way to expiration. I just want my fair share. I'm looking for the price to fade back down, take it off by buying it back, and then I'm out. Put credit spread is more of a limited risk swing trade version of a short put position. So think about this. The only thing that's different between the short puts that I told you about in the options program versus a put credit spread is that insurance option. There is no unlimited risk now. But a short put is really meant as a trade to allow you to accumulate. Now, it doesn't work this way in Deribit, because Deribit has cash settlement. But with things like LedgerX and with just about everybody else, you have physical settlement, and this is how you can get assigned that underlying coin, in this case, for a lower price. Now we'll get into the vertical debit spread. A little bit different twist. So some of these things are going to be the same. So same as a credit spread, buying and selling either both calls or both puts in the same series, the higher debit of the long option. So we've flipped the options around now. We're buying an in the money option, and we're selling an out of the money option. So that in the money option is going to be more valuable. It's going to cost more than the short option. So we're going to pay a net debit. We will pay to set up the trade. Now, a lot of people like credit spreads better because, I like being paid. I like being paid to start the trade. But as you'll see, they're exactly the same thing. There's really no difference. The difference is whether or not you get paid at the beginning or the end of the trade. It doesn't matter. So these work best when entered with low implied volatility. This is important. So now you can see a difference between the debit spreads and credit spreads. Credit spreads like frothy conditions. Debit spreads like slumbering, quiet conditions. So I'm generally using these at the money, straddling the price. This is not a straddle. I'm just using that verb, straddling the price. Or is it an adverb, right? Straddling the price, long option in the money, short option out of the money. So let's go to our position builder. This is what, now notice this, I don't have the same granularity. I had to go with a wider spread this time. 8,000, 9,000 call debit spread. So again, same deal, guys, same deal. Don't worry about any of this stuff down here. This is immaterial. This is superfluous. All we care about are these options right here. These ones right there. Okay, so we're buying an in the money, 8,000, and we're selling a 9,000 out of the money. It's a call debit spread. And notice we have a slightly different arrangement here. We're doing this right right around at the money. And notice how we have a balanced reward to risk. If you have a balanced reward to risk, also what that means is that you have about a 50% win rate. So it's now up to your skills and not just a coin flip towards you winning the trade. So here's your profit, and we're looking at about $500, and here's our max loss, and that's looking at about $500. You got a bigger spread width now, and that's why this one costs a little bit more. So let's look at the numbers. Okay, the long call cost me 0.115 BTC. The short call received 0.058. So that's a $482 debit, 0.057 BTC at today's price, $482. Max risk is what I pay for the trade. The maximum risk of the trade is what I pay for this spread. So that's a tremendously powerful concept that no matter what happens, if this thing blows up or completely tanks, I don't care. I sleep at night because I've defined my risk on the trade. Doesn't mean I'm happy. Doesn't mean I'm just completely, who cares, right? But I'm not going to be losing sleep over it. Probability of success is 48.2%, pretty much 50%. The maximum profit is the spread width minus the debit, or $1,000 minus 482, or $518. That's the most I can possibly make on this trade. We saw that with the graph. Yes, we saw that with the graph. No matter how high the price goes, I've capped my profits. I've also capped my risk. Cap my profits, cap my risk. Typically, you would close these prior to expiration. Starting to see the same thing show up again and again. Now, what do we use debit spreads for? These are typically placed at the money. A put debit spread is bearish. A call debit spread is bullish. There's actually some very genius things that happen with this thing. During quiet markets, right? Low implied volatility, where you've got a trending move. Say you want a trending move, right? So either what you can do is you can buy, you can buy a chunk of the spot. However, it takes a lot of capital, doesn't it? It takes a lot of capital. I mean, for you to see think about this. Let's go back to this risk graph again. Think about this. What kind of, you'd have to have a hell of a big position to get, a $500 gain on Bitcoin. Either a big position or you'd have to have a small position that went a tremendously great distance. In this case, we're risking 500 to make 500. And that's our initial margin is $500. That's it. So we're not eating up a lot of capital for this. Very efficient. During quiet markets where you see the possibility for a trending move in your forecasted direction, here is the genius of these types of at-the-money spreads, is this will null out the time decay and it will null out the volatility crush. Yay. Can't do that if you just buy a call option, guys. You can do everything right and the value of that call option will continue to melt. It's like friction against you. So it's a limited risk swing trade that you can leverage the gains of a much larger spot position with a fraction of that margin. But it doesn't suffer the problems associated with a long call option due to time decay, volatility crush, and all those other horrible things that they do. Okay, everybody good so far? We got one more to do here, which is called the straddle. Many people, I think I've talked about the straddle a little bit. And people do get excited about the straddle because it allows you to set up a trade without knowing what the direction is, but they're not easy. In fact, I do not trade straddles. personally myself. Very simple trade to place, very difficult trade to profit with, and I'll show you why. When you sense a big move coming, yet you don't know which way it'll go. And the longer you trade, the longer or the more that you will say, you know what? I don't know which way it's going to go. The more humility that you'll have, where perhaps it's less confirmation bias. A straddle is simply an at-the-money long put and call option bought for a debit. So all we're doing is let's bring this over here. We generally want to do these at the money. So right now, Bitcoin is 8,400. So we would say, well, probably we'll use that $8,000. So what we're going to do here is we're just going to buy this one and go over here and buy this one. Buy. That's it. So let's see this on the P&L graph. Here's what it looks like. Now notice that the red line is not perfectly centered because the strike granularity is no bueno. Bitcoin's at 8,400 and we're setting up an $8,000 straddle. Yeah, so right off the bat, we're not doing so good. That's the problem with granularity. With the equities markets, I can dial that thing in within, a couple of dollars, depending on what I'm looking at. Again, we're going to be looking at the bottom one here. Same deal, guys. Don't worry about any of this stuff here. None of this matters. We're just looking at these two here. And notice that we're buying a put and a call. Call, put, buy, same strike, same series, same expiration date. And I've talked to you guys about the straddle being basically an approximation for the expected move going forward. We've drawn those graphs, those arcs into expiration date, and I've showed you guys that. So this is the 8,000 long straddle. Now, some of you had asked about, what about a short straddle? You can do the same thing in reverse. You can do this. If you sold these, if you sold this one and if you sold this one, and what that would look like is something like this. It would be the exact opposite. But guess what? This goes down to 0, right? Goes down to negative infinity, and this one goes to positive infinity. So this can be a very dangerous trade. Just because you can do it doesn't mean that you should do it. However, the maximum loss that you can take on this trade, the long straddle, is what you pay for it, which is good. Let's look at the numbers. Okay, call debit, put debit, 0.165 BTC debit, or almost $1,400. So this is not an inexpensive trade. The max risk is what you pay for it, like any other debit. Price must move approximately $1,400 by expiration. Whoa, that seems like a pretty tall order, doesn't it? From now to the end of the year, you really think it's going to move $1,400? Maybe, maybe not. Don't know. The further it moves, the more you profit. Remember that the expiration graph for this looks like this. So if you get a $10,000 move, then what's happening is, to the upside, right? So if we get a move that goes crazy to the upside, what happens is that put option that you bought down there, that's pretty much zero. That's gone to zero. It's not worth anything anymore. But your call option is just going ballistic. Remember, a call option, the higher the price goes, there is no limit to the value of that. But the put option goes to zero. So that's pretty much the game that you're playing. is that you're looking for a big move. You don't know which way it's going to go. One of these options will go to zero, and don't think that you can figure that out halfway through, because what will happen is the price will start out here. It'll move down, and then you say, okay, let's get rid of that call option. Let's focus on the put, and then it'll go whoosh like this. Don't pretend that you know what's going to happen going forward. So what are the applications for straddles? These are placed at the money, as close to being at the money as possible. The best application is during super quiet markets where nobody is thinking that it's just not going to move, right? It's going to just stay in here. So that we've actually had a couple of good applications for this recently, where it's just like fibrillating and just barely moving and just very low implied volatility. Great application for straddle. Wish I thought of doing it. That's what I'm telling you. If you don't play these, you don't think about doing them. There's got to be a big price explosion. You got to go further than the expected move. If it stays within, remember that trade that we just looked at doing, $1,400. $1,400 plus minus. That's a big move. Okay, so it's really got to move a lot for this thing to happen. So it tends to work best on the downside, and this is because we bought too long options, and if the price falls off a cliff, then implied volatility goes like this, and then both of those options actually do increase in value. Straddles are very, very there. This is Vega. They're very sensitive to Vega, implied volatility. Annie is asking, how does the original cost of the option come into play? Well, it's like anything else that you buy and then sell later. It's like anything else that you go, buy and sell later. So like if we look at the put, and let's just say that we spent $100 on the put, and then we have our call, and let's just say we spent $100 on the call as well too. Okay, if this goes to zero, and if this goes to being worth 500, what's our profit on the trade? Well, the original cost basis was 200. Okay. So let's say in 200. Out. Nothing here. So it's 500 out. So the profit on the trade is 300. Profit is 300. That's what we make. So we've gotten a 50% return on the trade if we did something like that. That's a 50% return. So the price you'll pay is directly tied to the expected forward move and the current level of at the money implied volatility. So these are just a few. We just went over three. We went over credit spreads, debit spreads, and straddles. So I've kept the list to the simplest ones. We could do four-legged ones like butterflies. We could do diagonals, which are time spreads in different series. We could do calendars, which are the same strike price, different series. We could do iron condors. We could do long condors, short condors. We could do broken wing butterflies. There's all kinds of great strategies that are out there. Just because it's got a fantastic name to it doesn't mean that it's better. Just because it's got more wings to it doesn't mean that it's any better. Typically, the more complex a position, the longer it will take for you to earn a profit on it. So sometimes the very simplest ones are the most effective ones, the ones that you should be looking at using. So again, in the program, the reason why I started off with just simple options, just one-legged options, is because of these very rudimentary options platforms that we have. So you can't really do, that's the thing, is you're going to have to work each leg of this. And that, I've done some soul searching as to whether or not I should really be telling you guys about this, because you can lose significant edge if you don't know what you're doing in terms of entering the options, entering the legs. So please experiment with these on paper before risking real capital. The trade entry is never the main thing. It's always the exit and the risk management that's key. Just because you entered a trade doesn't mean that you can forget about it. Your work is just beginning at that point. Okay. Before I move on, I'll just pause here for a few seconds and see if there's any questions on this. So again, those are 3 new strategies that you can take. The easiest one, and probably the most conservative, is the debit spreads. Debit spreads are always going to be more conservative. You know exactly what your risk is. Try to do this, though. Try to do this. If you're going to be trading, try to be setting up trades where you have a smaller spread width. Like you can see this right now. Like if we're doing a call spread, the only way that we can do an at-the-money call spread is $1,000 wide spread. So that's going to be risking $1,000 or $500 if we use a full BTC. Now you can dial that down if you want to. But notice how there's a slight advantage here to look at the granularity here is the $500. So when we do our credit spreads, we can kind of make them not only maybe less than a BTC, but we can dial in the granularity a little bit better. And then of course, I haven't really talked about Ethereum all that much yet. Okay. It's misbehaving here. Haven't really talked about Ethereum, but obviously the granularity is much better. We're talking about a $10 spread width. Some cases $20, but much, much lower notional contract size. But most of the time I do talk about BTC just because it moves, it's got more opportunity, better liquidity. But Ethereum is probably not a bad place to cut your teeth with these. Does knowledge of fractal energies mitigate the risk? Okay, so that's a great question because you've got really 2 elements here, okay? So let me get out the pen. You've got technical analysis. Now, what is this good for? Technical analysis is good for showing you, basically the mode that the price is in, range, contraction, or, range expansion, and the likelihood of it moving from one to the other, right? So you can tell things like trend, you can see whether or not you're getting into consolidation, stair-stepping behavior, those kind of things. So basically what I would say is that what technical analysis is best for when it comes to options is defining the entry, but not the exit. Never, ever, ever use technical analysis to define an exit. A good example of that would be, hey, we have this ascending wedge, the price is doing this kind of thing. And the price butts up against this ascending wedge and you go, well, I can sell a call spread up there because it's just going to fade back down. This is typically when we see them kind of go whoosh, like that, straight above. So only use TA and fractal energies as an extension to that for determining your entries. So let's go over to the other side. Now if we just go over here to, I'll just call this probabilities. and maybe even just say option probabilities, because nothing else has got probabilities attached to it. Futures don't. You can use these for, I guess, what I'd call, you can just say random walk. Random walk means that you think charts belong at the bottom of the ocean with all the other sunken galleys out there. And there's, quite honestly, a lot of people, especially people in Chicago, that trade options do not believe at all in charts. So they think that all of this range expansion, range contraction, trending, and all that other stuff is a bunch of hooey. All they do is they just use the probabilities. They say, I don't know what's going to happen tomorrow, which I truly believe in. I don't know what's going to happen tomorrow, but they don't even think that they can. There's no structure to the price in their world, which I vehemently disagree with. But exits, option probability and exits, this is where, and I would also say portfolio, like portfolio risk. You can't do portfolio risk with technical analysis. TA to me is really best for determining what type of asset that you want to trade, what kind of entries that you see in terms of, to give you a good example, I mean, this is such a deep question that this is why I'm kind of going on a little bit with it, because I've answered this many, many times over the last decade plus, is that what I will do is, again, just the, to me, the TA gives me the edge on the entry. But once I'm in the position, this is where I could just completely look at either, what's the debit on this thing? What is it to get out of it? What's the probability of me winning the trade? But I don't use charts after that at all. Purely entry, and then so it's kind of in between the two. So what you'll find is a lot of people get very religious on this. They'll either do everything technical or they'll do everything random walk. But to me, it doesn't, if you look at something like this, like when you get a market that's doing this, that's coiling up and is building a lot of energy, this is where the option guys are saying, there's no movement. There's no movement here. This thing has gone flat. And so they're predicting no forward movement at all. And over there, I am saying, hey, I think there's a great chance of forward movement. So this is where I have a huge edge in doing something like this, whether I'm using a straddle or some type of like long condor. Big edge, especially if it breaks. Okay, so I could go on forever on that one. Let me move on to, we just did an hour here. I told you guys this is going to be a big one. Okay, Deribit futures. We'll try to get this wrapped up in maybe the next 10, 15 minutes here. So I got a request to talk about Deribit, the futures interface for Deribit. What's different about it? How do we use it? Those kind of things. First of all, disclaimer, I've taken very few futures trades on Deribit, just one or two. They're going to be using KYC pretty soon, so they're going to be kicking me off. And I don't want to be wasting a whole lot of time into something that I'm just never going to be able to use again. So I'll communicate their feature sets to the best of my ability. However, there's nothing like direct experience. If you see something that I'm saying, if I'm being wrong-headed on something, call me out. Let me know, and I'll get it fixed. So Deribit offers both BTC and Ethereum futures and perpetual contracts. I will also focus on BTC futures versus Ethereum, since they're typically more liquid. They're the big boy contract. BTC tends to move more. So Deribit has short-term futures contracts, long-term futures contracts, and perpetual or synthetic futures contracts. So if you look at this, I'm going to bring over the chart again, or the window. If you guys look over here, you'll see, right, this is what I'm looking at here. Right in there. These are the futures. These are the options. Okay, so the futures are what we're going to be looking at over in here. So there's three different types. Three different types. Which should you trade and why? Where can I find out how much of my profit is from leverage? I don't know how to answer that. Not quite sure what you're asking. And why do I sometimes get margin on buys, but not on sells and vice versa? I wouldn't believe anything that you see on testnet. Testnet is pretty funky interface. So what you have to do is, as far as leverage, you have to understand what you're leveraging, right? It's just a linear relationship. There's nothing funky going on. You're assuming what you're doing is you're multiplying a position by, in some cases, by 100. And so you're getting the gains and losses of something that's 100 times what you're actually risking. Okay, so let's get back to here. Perpetual future contracts. These are the most liquid instruments provided in a vendor's offering. The most liquid BTC contract is on BitMEX, period, in the whole space. Perpetual futures contract is best for intraday short-term scalp trades. These are traditionally mostly what people are doing. Deribit has an 8-hour funding window. And if you watch it, sometimes it's 0.004%, sometimes it'll drift up to 0.008. It's a small funding window that allows them to turn a futures contract into something that gets funded every day. You don't really need to understand that. Just understand that holding overnight or holding for longer than 8 hours is eventually going to cause a little bit of friction. Deribit allows multiples of 10 contracts. So the very smallest position size you can use is 10 contracts, which is literally next to nothing at all. So currently a 100 contract position would require 0.00012 BTC initial margin, or about a dollar initial margin to do 100 contracts. Wow. Okay. So essentially what you're doing is you're leveraging a position that's going to get the gains and losses of $100, but you're only going to put up $1 of initial margin for it. So you don't want to be holding these positions for any length of time. You don't want to be swing trading them or using them to hedge your positions, right? Just the drag of the funding rate will eventually wear down. So that's why we have these short-term futures contracts available too. Only has about 10% of the volume of the perpetual contract. Now, what does that mean? Well, we'll get to that. This can be used for intraday or short-term scalp trades, but could be very dangerous to post a stop order on the books. I've seen this. I've seen this happen. You can look at the price of some of these contracts too, and you'll see it do something like this. You'll see it like moving up and down very slightly, and all of a sudden, moving up and down, like with these huge spikes just for milliseconds. And these are stop runs. These are stop runs. You don't want to do this. You don't want to use a short-term futures contract and put a bracket on it. So it's a good instrument for a short-term trade or hedging portfolio, one that you put on and say, maybe I'm going to hold this for a week, but don't put any stops in there. You can put limits on there. That's okay. A limit is okay because a limit infers that you're looking for a profitable outcome, and that'd be fine. If they want to push it up there to fill your limit order, let them knock themselves out, but don't you dare put stops on there. There is some cost to carry that will eventually normalize to the spot contract by expiration. So what I mean by this is that if here's the spot price This is almost like an option in that there's a little bit of a cost to carry that eventually will disappear. This is called cost to carry. So by expiration of that contract, it will be the same as the spot. So Deribit allows multiples of 10 contracts, same leverage, long-term futures contracts. Not very much volume here. Good instrument for hedging a portfolio over a longer time frame, like they have a contract that's good for 27 March of 2020. So it's good for, 4 months. So if you want to hedge your portfolio, there you go. You can go short a contract or 2 or 10 or 20 of that futures contract. Larger cost to carry premium, 10 contract minimum. So let's focus on the perpetual contract because quite honestly, most of what you'll do is on the perpetual contract. If you're doing scalps or anything like that, that's what you'll be using. Now the trading fees of this depends on whether you're a maker or a taker. A taker order means that basically you're just punching into the position. It removes liquidity from the order book. So basically you say market order, boom, go. You're going to get charged the taker fee, which is 0.075% of the notional value of that contract. It's not much, but it adds up over time. However, a maker, this means that, guess what? All you guys are out there saying, oh, I hate those market makers. Those guys suck. They're evil people. Well, guess what? A maker is you. You're part of the maker. You can become a market maker by putting orders out there that don't get immediately filled. You're adding to, you guys have seen this before, those graphs, the depth of market. Here's all the buy orders. Here's all the sell orders. And then here's the price discovery is happening right there. This is where things are being swapped. So if you put a buy order down here, you're adding to the depth of the market. If you put a sell order up here, you're adding to the depth of the market. If you put a buy order here, you're going to get filled immediately. You're going to be a taker. You're going to get charged. So this is very common to the other spot currency markets. Basically what this means is don't enter a market order unless you're absolutely necessary, like just punch out, get me the hell out of this trade right now. Then paying that 0.075% may be worth it. So let's move over to the interface. Okay, it's fairly simple. These are all pretty much the same. Deribit is pretty much the same as everybody else. They all use this sort of, quite honestly, lousy Forex style interface with big green and red buttons. So what you're doing is you're going to use limit for the majority of your orders. You're going to specify the quantity and the number of contracts. So in this case, we're leveraging $1,000, which is 0.118. And it's going to be using 100x leverage for this. Okay. So here's the current price. And this is where you could become a maker or taker, because if it's, somewhere down here, if you're entering a limit order down here, then you become a maker. If you enter a market order, or if you put a limit order of, something above the current price, you're going to get filled immediately and you're going to be a taker. So it's fairly simple just to get into a position. Okay, understand that your buy margin, this tells you how much capital you got to have in your account just to open up the trade. All right, so a lot of these things I wouldn't worry about too much. So if I go to enter this position, what it's going to tell you, here's your margin, here's the current price. Buy $1,000 of BTC in perpetual. Estimated liquidation price. So this is for my entire account based on this position size. is the BTC has to go down to, and I've got like a quarter of a Bitcoin in this account. So it's not necessarily very big. But BTC for this position, if I enter this position, it would have to go all the way down to 26.91 to liquidate this position. Okay. That's a long way. You don't want to allow it to do it. You never want to use the liquidation as a stop price. If you do, that means that you're trading with too little capital and you're just going to go back and forth. So lacking a ladder interface, I've showed you guys what a ladder interface looks like, and this is what Digitex is going to be coming out with, is a ladder interface. We need to build a one cancels other order. Now, what this means is if you go long here, let's say we go long at this price here, and I'm going to draw this like a ladder. What I'm going to do is I want a limit sell. Here's a limit sell up here because I want the price to go higher, right? That's a limit sell. And then I'm going to have a sell stop down here. Now let's flip around and do the opposite side. If I'm going to go short, if I go short, so I want the price to go lower, then what I'm going to have is I'm going to have let's draw a bracket. This is going to be a buy stop. A buy stop. And this is going to be a buy limit. Okay, so you want the price to go lower like this. In this case, you want the price to go higher. Limit sell, limit buy. Okay, that's what a bracket means. And so what we basically have to do is we have to build a bracket. Once you enter a position, you need to immediately enter the limit and stop loss order. So entering a limit sell at a price above. And if you're short, you want to limit buy at a price below. And this is something that I learned recently, clicking the reduce checkbox, which is, let me bring this up again, will ensure that the other unnecessary order gets removed. So the problem is that if you build a bracket like this, let's say if I went long, the price goes up to here, boom, takes me out of my limit. Guess what? I still have a sell stop down here. And what can happen is the price can go up here, and then all of a sudden sell stop is still open. I just entered a short position. Not good. I've done this many times over the years before we're able to get, a lot of the ladder interfaces used by like interactive brokers and things like that were just very primitive. And you had to be like super disciplined to remember to clean up your order. So this is what you got to do. But using the reduce checkbox, from what I understand, is something that can help you. So if we go over to, if we go to perpetual, okay, so I'm not going to enter a position here, but this is what we would do. We, buy this position, go long in here, and then what we're going to do is mark down, obviously, remember what's rule number 1 of risk management, determine your exits before you enter the position. So you've already determined what your exits are, whether it's a profitable or a loss exit. And so what you're going to do is you're going to enter, like in this case, for a stop, you're going to enter a stop market, sell. And I have to put in all this stuff here to put that in because there is no position, so I can't put a stop market in there. But also you're going to put a limit sell. You're going to put a limit sell at a higher price than your long entry based on your target for the trade. Okay. So why use Deribit versus the other brokers that are out there? There's a number of them. A year ago, I said that 2019 was going to be the year of the derivative. And it pretty much has been. The primary reason why I would use Deribit is because it's nice to have this one size fits all account. It's nice to have all your capital in one place. You can write options against it, take trades, option trades. You can also do futures contract trades with this. This is nice. Okay, the trading interface is just okay. There's nothing special about it. The markets appear to be deep enough. They appear to be liquid enough. It works. But whomever comes to the market with a true ladder interface will be who I use next, if they will allow me to. Let's see, futures liquidity is good. I've not heard any complaints. A lot of people complaining about BitMEX, forced liquidations, those kind of things. But quite honestly, I think most people on BitMEX can be difficult to use just because there's a few more dials on there. And there's a few more things to learn on the interface. That's not very clear, but they are the big gorilla in this space. They've been around for quite a while. And my friends, that is all I had for today's trade school. That's really all the time I have for it. We've been going an hour and 20 minutes and the voice is starting to crack. So let me know what questions that you have with today's session, whether or not you're live here today with me or whether you're watching this on a replay. And I'd be happy to address those either through email with you, or I can always set up a reply in the next session that we do. Yeah, Andy, I don't know the questions. Those might be a better question for somebody at Deribit. Just don't tell them where you live. Okay, going once. Any final questions for today's session? Going twice. Hope everybody has a great weekend. Stay warm out there. A lot of cold people. Winter came early. Winter came early today, except for those folks in Arizona. I was just out in California. I was just visiting Mav last week, and wow. Very seductive place. Very nice out there. Okay, guys, I will wish you a great weekend for everybody. Have a good one. All right, folks. See you later. Take care.